Hello and welcome to our very last lesson of financial literacy. Today we are looking at mortgages. You're going to be able to explain how mortgages work and also to build amortization tables for mortgages specifically, and just as well as some other loans specifically for vehicles. So big payments and their respective loans that you might have to utilize in the near future for yourself. So s- Consider you want to purchase a house for $650,000. How can you complete this purchase? And how do families typically pay for homes? So, families typically use mortgages. So, a mortgage is a loan from a financial institution that's used to buy a home. The loan is repaid over a set period of time, and that period of time is called the amortization period. And of course, you are paying interest on it. So it really isn't common for people to have $650,000 or depending on how much the house costs, to have that much amount of money available in cash or even in their bank accounts to be able to pay for that upfront. So they typically pay the amount that they do have, and then the rest is borrowed from the bank or financial institution as a mortgage and is paid off over time. So, how a mortgage works, we're going to look at this diagram with a timeline of the steps that it takes. So, first, you have to know what your goal even is. So, typically, what range of houses are you looking for? Are you looking in the millions? Can you only afford $500,000? So, what is your budget? And that can depend on your income, other expenses you have, how much you've saved up already, and also your credit score. So that can highly affect how much loan the bank will offer you. So if you don't have a good credit score, then it's not really realistic for you to be looking at higher costing houses because you might not be approved for them. Then, once you have a goal, then you start, or you already perhaps have saved up for your down payment. Remember, down payment is a percentage of the total cost of the house that you pay up front, and you get a mortgage on the rest. So typically that's between 5 to 20%, closer to the 20% side. And depending on that, your down payment, that can also influence your rate for your mortgage, as well as the amortization period and other components of the mortgage. Then, once you found a home that you are looking to purchase, then you have to apply for a mortgage with the bank and you have to get pre-approved. So, before you can even think about purchasing the house with the buyer, you do have to ask the financial institution if they are willing to offer you that mortgage. Once they have approved you, then you can make an offer to the seller of the house and maybe even negotiate the deal depending on if there's a high demand, or perhaps maybe there for some reason they might be more prone to giving the house to you. So then you have some leeway for negotiating. Then you finalize your mortgage, which means that the lender, which is typically the bank, completes your appraisal, verifies all your information, and they sign off on the mortgage. And on the closing day, you pay your down payment and the any closing costs that you have to, any extra fees that you might have to pay, and the bank automatically sends the money to the seller to complete the transaction for your house, and you have purchased a house. So, here we just have the definition of mortgage again, but one thing I want to point out to you is that anytime a house is paid off using mortgage, that house is used as collateral, which means that the lender, which is again typically the bank, has a legal claim to the property until the loan is fully paid off, which makes also sense. If they paid off for the house, then the house is technically theirs and until you pay it off. And how you pay it off is through monthly payments in which you are paying the interest as well as parts of the principal payment. And so over time, as you pay off and make more payments, then more and more of the house becomes yours until eventually you've paid it off and the house is completely yours. So you do have to make payments on time to avoid penalties, and your mortgage payments also affect your credit score. Um, Anytime you have an extra, uh, for example, income that comes to you, you do have an option also to pay off more than your monthly payment. So let's say you randomly win a prize, or you get an inheritance of $10,000 and you want to use that to pay off a big part of your mortgage, then you can automatically make a $10,000 payment. And that can also help you pay off the mortgage faster and also save on interest, because then you're paying off the mortgage in a shorter period of time than previously agreed upon. And again, with any types of loans, please make sure you are planning wisely, borrow responsibly so that you can build your wealth, which would be your home. Your home is still an asset that you are investing in. So if you are uh, spending irresponsibly, then that can highly impact your not only your mortgage and credit score, but also your ability to maintain ownership of the house. So some key vocabulary. I won't review every single term, just the ones that I think are new or perhaps need revision, because a lot of it has been repeated by now. One thing that might be new and it's important is equity. So equity is the portion of the property's value that you own. So based on how much you have paid off, how much of the house do you own? So if you paid half of it off, then half of the house technically belongs to you, and the other half is still belonging to the financial institution, the lender, which again, typically the bank. Now, for the rate for mortgages itself, we have two types of rates. We have fixed rate and variable rate. So, with fixed rate, the interest rate remains the same for the entire mortgage term, and this is more consistent with your payments, and you know pretty much what to expect. However, variable rates, they can increase or decrease, and that can depend on the market interest rates, and your borrowing costs can change over time. So, one one reason you might consider variable rates is because there is a chance that they might decrease, which means that after one term you might be able to pay less interest rate, whereas with fixed rate, even if the market changes, then you are still paying that rate. But you can also consider it the other way, where if the market interest rates increase, then with rates you're also paying more, whereas with fixed rate, that's the rate that you had is the rate that you have. Now, with mortgages as well, we have term versus amortization period. So, term is the length of your mortgage agreement, and the the interest rate is determined based on that period, but then after that term is done, it is that interest rate is renewed or renegotiated. So, common terms are 1 to 5 years in Canada. So if you have a 2-year term with a specific rate, after the 2 years, that rate is recalculated, and then you have a new term that you have to pay that rate on. Now, amortization period is the total time period in which you're paying the mortgage. So that means that, for example, common amortization periods, which are 25 to 30 years, the expectation is that by 25 to 30 years, you have paid the mortgage off fully. That's if you're making all the payments on time. Now, refinancing is when you are replacing an existing mortgage with a new one. That could either be to get a lower interest rate, it could be to change the repayment period, or if you need to borrow additional money, because by a certain period of time, you've already paid off a certain amount of the house. So now you have home equity, which is again the value of the home that you actually own. And so now maybe you want to make another purchase, you want to buy another property. So then you might refinance in order to get more a bigger loan, or again just to for other reasons as well. Now, with the compounding period for mortgages in Canada, fixed rate mortgages are legally required to compound semi-annually, which means twice a year. However, for variable or adjustable rate mortgages, these compound monthly, or it could be based on your payment frequency as well. So let's look at now our first example where we're looking at one big example and analyzing many different aspects of it. Here, Gregory is purchasing a house that's for $100,000. He makes a 20% down payment and finances the remainder with a mortgage. The bank offers him a rate of 4.8% annual interest rate and is compounded monthly with a 25-year amortization period. This means that he's making monthly payments, and over 25 years, he's paying off this $400,000 house. So first calculate Gregory's down payment. So he makes a 20% down payment. So if we take 20% of the house value, which was 400K, then 20% is $80,000. So he makes a down payment of $80,000, which means when he purchases the house, he pays $80,000 of it right away. And so now determine the amount of the mortgage. So he pays the remainder of that through mortgage, so he finances the remainder. So if we just do a subtraction, that's $320,000 that he's borrowing from a bank or financial institution. Now, calculate Gregory's monthly mortgage payments. So here we have the present value, which he has to pay off, which is the $320,000. And we want to find the monthly payments, which remember from this formula, we are looking for R. So I can already rearrange this to set up for R. R is equal to P times I and divided by this numerator here. And now analyzing all my different variables here, the interest rate was 4.8% per annum. So compounded monthly, we have to divide by 12. And this is approximately 0.004. But again, if you're when you're using a calculator, just use this fraction to keep an exact value. So he's paying monthly payments over 25 years. So that means N is going to be 25 times 12. So 300 payments in total are made. And now filling in the rest, all our variables in our equation, we get that R is equal to $1,833.59, which means that he makes this amount every month as his payments. And remember, this already counts for the interest that he's paying off as well. So now we're asked to complete the first 6 months of the amortization table, and all values should be rounded to the nearest cent, so 2 decimal points. So in the first month, from the $320,000, if he is charged that 0.004 interest, then that's approximately $1,280 of interest, which means that of his monthly payment, which was from up here, $1,833.59, then if we subtract the interest, then he pays $553.59 of the principal. So of this $120,000, he only pays off $553.59 in the first month, and almost 1,300 of it is just interest. So then the outstanding balance is just subtracting that, and we get $319,000, $319,446.41. So again, remember we have, in this case, this is just our number of payments or just the month. So this is after 1 month. The payment per month doesn't change. We just keep that. However, the interest paid and the principal paid will be different based on the outstanding balance. So remember, calculate based on the outstanding balance what the interest paid is. You have the interest rate and subtract to get your principal paid. And so now, take a moment, complete this on your own, or at least give it a try. The answer is on the next page, but give it a try for yourself as practice for this unit. So if you had filled it out, these are all the answers that you should have received for all of his payments for 6 months, over 6 months. So now we're asked how much of Gregory's second payment goes toward interest. So looking at the second month, so this is just again calculated from this outstanding balance the month prior. We just multiply by 0.004 and we get $1,277.79 goes towards interest. Now we're asked how much principal has Gregory repaid after 6 months. So you have two options here. If you are using spreadsheets, you can always use the sum function to find the total. So I can find the sum of this column over or oh, because it's the principal, sorry, the sum of this column and find my answer, which is all of these values added together, and it gives me $3,354.93. Another way you can think of this is his outstanding balance after 6 months is $316,645 dollars and 7 cents. This is how much is left of the $320,000 dollars. So if you subtract that from the remaining balance from the principal amount, then you get the same answer, $3,345.93. So, of course, this method is more efficient because you're only doing one subtraction as compared to many additions. Because you might also be asked how much principal has been repaid after uh, 12 months or after 18 months. And again, if you have that outstanding balance after the 18th month, then you're just doing one subtraction. Or if you are using a spreadsheet, the sum function should also give you a very efficient answer as well. So, why does the amount paid toward principal increase each month while the interest portion decreases? So again, why is this amount increasing while these interests are decreasing? So this should be a review by now, but the interest paid is based on the outstanding balance. So each month when you make a monthly payment of the principal amount, then your outstanding balance is decreasing, which also means that your interest paid is decreasing. However, since your monthly payment does not change, then when your interest decreases, that means of that monthly payment, which is consistent, then more of it is the principal paid, which also again aligns with you having a lower outstanding balance. And we also saw this in a prior amortization tables as well. So now, just some other types of loans, just to introduce you and for you to think about. Of course, we have car loans. So if you are purchasing a vehicle, typically these are monthly payments lasting between 3 to 8 years. You also will have student loans very soon if you are going for post-secondary education. So in Ontario, this is OSAP, but it could be different amounts or depending on where you're located, you will have different student loans. Typically, repayment for these begin after graduation, or there is a grace period. If you are still looking for jobs and they understand that you don't have an income, they'll give you some period of time for you to be able to find a job and then start the repayment. Next, we have line of credit, which here is the student line of credit or just the regular line of credit. But these are typically smaller loans that are given to you by the bank, and you can choose to spend it, or you can just choose to open a line of credit just to have it as part of your credit history. So remember when you have credit cards, you have credit scores. So sometimes when you have multiple credit lines or credit cards and you're making timely payments on these and you're being responsible, then your credit score can also increase because they understand that you are using all of these loaning options responsibly. So sometimes you may choose to just open this line of credit just to have it available to you, or it could just be just for emergencies situations as well. And with these, they with the student ones at least, they cover education related expenses. And you do pay the interest while you're still studying, so there's not a grace period for the interest unlike the student loan. but you can actually pay the principal amount later. So you can perhaps use this for tuition or even just for other costs if you're living away from home while you're studying. Um, but one thing with student line credits is they often require a co-signer, which means that someone else who has a higher credit score or a better credit history has to sign with you, which means that if you're not able to pay, they are taking responsibility for your loan and they will be able to pay it off if you're not able to. Then we have personal loans, which you could be using for travel, if you have home improvements, or just in case of emergencies. And with these, again, they're fixed monthly payments over a set period of time, which could depend on the amount of the loan. We related to that also have line of credits, which are flexible borrowing options for it could be ongoing expenses or emergencies, and they could be considered as like another credit card option. And with these, the interest is charged only on the amount that's borrowed. So if you have a line of credit and you're not borrowing any amount, then it will just stay there. You don't have to pay anything on it. And finally, there's business loan options, which if you are starting, expanding, or operating a business, you might take out a loan to be able to fund that. Other options for that could be investors, but if you're unable to find investors, then you may ask for a business loan, or perhaps with investors, keep in mind with equity, right? If other people are putting in money into your company, technically part of the company is theirs. Whereas if you are taking a loan, yes, the part of your company might belong to the bank until you pay off the loan, but once you do pay off the loan, then the business can be fully yours. So ownership is a big part to consider as well. Now, another big one or big purchase that comes to mind that it's good to know about is when you're making a purchase for a car or a vehicle. And you will have three options there. You can, of course, buy with cash, which means that you pay the full price up front and then the vehicle is yours immediately. You can go for auto loans or financing options, which means that you borrow the money to buy the vehicle and then you make monthly payments. And once the loan is repaid, you own the car. Then there's also leasing options. So you're still making monthly payments for a fixed term, but at the end of the lease, there's two options. You can either return the vehicle and get a new one, like lease a new vehicle, or if you really enjoyed the vehicle, you can make a payment for the remainder of the amount of the vehicle that you haven't purchased, and then you can take ownership of the vehicle. So leasing could be an option. For example, if you like driving new cars, then you can frequently lease, and you will always have like the latest models of cars, or you can just, if you're not sure which car you want to commit to, then you can try different cars for periods of times until you figure out which one you want to purchase for long term. But with leasing, again, because the vehicle is not yours, you do have to exercise caution. For example, if it is your own vehicle, if you crash it and you aren't able to pay for the damages, uh, at that point and the car is still able to drive, then you might be able to live with that. You will say, okay, for example, my car needs a paint job. I can't afford it right now, but I can still drive it and I'll fix it when I need it. Or if you're buying secondhand cars, especially if you're a new driver, then you might not even care and you might just damage that car until you're a more confident driver, and then you can purchase a better car that you're going to use safely. However, with leasing, because the car does not belong to you and you are returning it, you are borrowing the car technically. So then you have to be more cautious about damages, and you are definitely accountable for any damages, and you have to make those payments. So again, think now, when might you consider buying with cash, auto loans, or financing, and leasing when it comes to purchasing vehicles, and what are the advantages and disadvantages of each? So just a little table to put all of that together. Not necessarily to say one is better than the other. It really depends on your situation, your budget at that time, and what your intentions are with that vehicle in that at that point in time. But when you buy, of course, you are owning the car immediately. You don't have any monthly loans. There's no interest because you're paying cash. It is a higher upfront cost, but in terms of long-term ownership, it is the best option. With financing, you will own the vehicle after the loan period is done. You are making monthly payments and there will be an interest charge, and the upfront cost might be medium because you might be making a down payment there as well. And it is a common choice to finance a car because you can maybe perhaps afford a uh, newer model car as compared to if you buy, then you may be more limited based on how much cash you have available. And finally, with leasing, you do not technically own the vehicle. You still make monthly payments. You might have lower monthly payments, and consider with that or compare that to financing, where financing the goal is that you pay off the car in that over that term. Whereas with leasing, you may only pay for part of the car, and at the end, all the payments that you have made don't necessarily give the car to you. You have paid maybe a portion of it, and you have the option to pay off the rest, but if you choose to not go with that option, think of it as when you rent an apartment or a house, then the money that you pay goes technically to the owner of the house, and after your renting period is done, you do not have ownership of that house. And of course, that has the lowest upfront costs because you just pay for the monthly payments, and this is good for short-term driving. So um, you can always negotiate the terms depending on your needs. And that was it for our financial literacy unit. This is the end of our lesson. So please make sure you complete the practice problems, check Google Classroom for any additional tasks or readings. And as always, don't hesitate to reach out if you have any questions, and I will see you all in our next unit.